No, not an issue. We'll start. Yeah.
And these youngsters, they have their own problems,
Yeah, I get it. Yeah.
because all New Gen people, they get up very late and.
No worries. It's okay. We'll start. 2 minutes. We'll start.
No problem. I will wait because I'm just for fun only. I'm just enjoying this course. No problem. They are serious, I am also. For me, I want to get engaged this theme of four papers I have. Other people,
Nice.
they are very youngsters. They want to go for it.
Hi, Bhavani. Hello, dear. Chalo, we'll start at least. Tom, Bhavani, we'll start.
Good morning, sir.
Good
Yes,
morning, dear. Bless you. Just 2 minutes.
Hello, sir.
Yeah,
Sir, I heard about this treasury shares. Treasury shares is a repurchase shares, no?
yeah, the buyback shares. Yeah.
Buyback shares. That is not used for dividends, anything like that. It will be just like that only. It won't be outstanding. This
No, they are not outstanding. They are now owned by the company itself.
but that dividend is not paid.
No, it doesn't make sense, na, because the company itself owns their own shares. The
Yeah, but
treasury stocks are like, for example, those shares the company which has bought back.
yes,
So
but that means outstanding shares will be constant.
see, if you are writing treasury stocks on your books, that means you have yet not you have yet got the same number of outstanding shares.
Hmm.
Just you have written the ones which you have bought back, you have written that separately.
Yeah, that is separate. But the outstanding shares for the outstanding shares for the company, it will be same only.
Yeah,
Just
yeah. Outstanding.
it won't be
Gross basis, it hasn't changed.
basic share per basic value won't change. I mean, share per value won't change. I mean, outstanding shares will be same. Correct.
Again, gross value, gross number of shares will remain same.
Hmm.
On net basis, the number of shares have reduced. Gross basis, the number of shares are same because they are still on the books now.
Yeah, yeah.
Okay. Okay. Chalo, we'll continue. Hi, Kostu. Bhavani, we'll continue, dear. Bhavani,
Morning, sir.
Tom, good morning.
Yes, sir.
Did we wound up the convertibles in the last session, right? Convertibles we did, right? Convertibles, to my memory, we did conversion premium.
Done, sir.
Yes. Correct, na? Okay. We were
Is it
discussing
done?
warrants are pending.
Warrants are pending.
Okay. So we're discussing warrants. How does the warrant work? See, just imagine, there's a main product, and with that there is an attached product. Okay. The main product, and with that there is an attached product. Okay. Now imagine if the main product is a bond, a debenture. Okay. Now, as a company, I need money. I went to the investor. Investor says that, okay, I'll invest into your company, but in debt, and I want a high return because your business is risky. Appreciate. So investor is willing to put money, but he is wanting for a high rate because our business is risky, young. So yeah, he's not wrong actually. Now the question starts: if he's asking for more rate of return, if he's asking for more rate of return, that would mean we would have a higher cost of capital. Again, if we have a higher cost of capital, that goes against our value maximization principle. We would like to minimize our cost of capital. In that case, very cunningly, what do? Is attach a sweetener to the deal, a warrant, a sweetener to the deal. Try to convince the investor कि please accept a lower return on the bond. Against that, we will attach warrants to your main product, that is bonds. The warrants will be like call option. The warrants will be like call options, which will give the investor a right to buy shares into my company at a rate which we have fixed today, which will usually be a very, very low rate, fixed today. Take your time in understanding this. The company needs money. It's a risky company. Now, because we need money, the investor knows that we are risky. He's demanding a higher rate of return. We need the money, but we don't want to pay the high rate. So what do? We attach a warrant. The warrant kinds of sweeten the deals for the investor as well as for us. For us, it reduces the rate of capital. That means the cost of capital. For the investor, of course, the reduction in the rate of return for the investor is not a welcome deal. But what does the warrant do? Warrant gives him, the investor, a right to buy my shares at a rate which we have decided today, which if the business flies, if the business makes plenty of money, if the business increases the value, the warrant becomes a far more enriching asset to the investor. However, if the business doesn't do good, the warrant will become worthless. Have we understood? Guys, have we understood? Kaustubh, Bhavani, Tom. Thank you, Kaustubh.
Yes, sir.
Bhavani ji, thank you, Tom. Kaustubh, have we understood? Bhavani, have we understood, dear?
That is attached only to the bonds, right, sir?
No. See, see, warrants can be as a product. Warrants, it can be attached to anything. Okay, you can. I can issue warrants to my employees as well. Correct. Basically, the nature there becomes ESOPs. See, warrants ideally works like call options written by the company itself on its own shares. But these are not conventional options which trade on the stock market, that is on the secondary market. This is primarily some kind of corporate action which the company wanted to favor itself. The company wanted the corporate action to, work in their favor, or at least do not something which was going terribly wrong or terribly bad. The company wanted the deal to sweeten. So what did the company do? Company issued a warrant. So the bond or a preference share is a classic example to make you understand that if you raise money and the rate of, the cost of capital, the rate of return is higher, warrant can pull it down for you. So provided for the next 10, 12 years, you can enjoy that money at a cheaper cost, thereby create wealth. What you are doing is giving the bondholder a warrant. The warrant becomes detachable. The investor can give you his warrant back, give the strike rate, the exercise price, take the shares of the company and enjoy his wealth because he participated in the risk the time you needed his money. Just 1 second. Yeah, Tom, please.
Sir, if
Just
the
Tom, 1 second. Tom,
if the bond or preference.
Yeah, please continue.
If the bond or preference share, if after issuing these warrants along with the bond.
No, I couldn't understand. Please.
If the suppose bond is that bond is issued with the warrant, and then it is traded in the capital market. Then if it is traded in the secondary market, it is able to attach these bonds also. That's warrants also can be attached. It won't be detached from there. It can
be detached.
It can be detached. So warrants. Take only the warrants, and then other bond can be sold off. Be sold in the.
Technically, the investor has now two instruments with him. One is the warrant, other is the bond. He can sell off the bond separately, and he can still preserve the warrants for himself. See, Tom, happy to know that you are thinking. The issue is now, Tom, this particular market, I mean to say the over-the-counter market. Okay, I'm saying the OTC market, which is the dealer's market, or probably if you have some intermediary in between. Point is, Nadir, that here in this market, if there is a demand, if there is a supply, things can be managed. I mean to say, if let's say tomorrow Kaustubh wants to buy a bond of the company, okay, which is giving only 7% return, correct? What is my problem? I'll give it to Kaustubh. In my world, Kaustubh, don't take it personally. In my world, he's an idiot. Kaustubh, should you say you're calling me an idiot? Yeah. Kaustubh should, why, sir? Because that bond was supposed to command 12%. But if you are willing to buy it for 8%, 7%, where should I be? Where should I be wrong? I mean, by selling it to you, correct? Kaustubh should be, but sir, I'm not an idiot. I will buy that bond as a steep discount in such a way that I get 12%. Guys, understand? There's a pricing mechanism. Costume is not dumb. I was thinking that I sold him an asset which should give him 12%, yielding only 7. Costume is not dumb. He'll price the asset in such a way that it offers him 12%. And I can still keep the warrants with me. Tom, it's not complicated.
If it is 12% means it will be price will be very less.
Yeah, exactly. Costume got the point, na? Got the point, na? In my world, I was acting smart. Wow, I got rid of an asset. Costume is like, sir, I'm not going to buy it at par, huh? But it was supposed to give me 12%. You're offering me a bond which is giving 7%. Hey, come on, guys. Correct? So Costume will be, sir, issue me the bond at significant discount. The pricing of the bond done by Costume will be in such a way that he will earn at least 12%. Because anyways, warrant is with me now. I'm not selling the warrant to him. Oh, lovely. Correct. Thank you. Kaustubh, I hope all is good, huh? Kaustubh, sir, I'm late and you are calling me
Yes.
dead. No, not at all. You are too super smart. Okay. Chalo. Kaustubh, Tom, Bhavani ji, in this example, to be honest, created by Tom, we get to learn that there is a secondary market. We get to learn their pricing works. Pricing will not be at par. It would depend upon the market fluctuations. Like when bought the bond from the company with the warrant, if I detach the warrant's value becomes lower. Hello. Are we clear, sir? Bhavani ji? Yeah. Thank you, Tom. Kaustubh
It
done
will
na?
be a deep discount
Yes.
bonds.
Yeah. Can't use that word. Can't use that word in the context, but you can say it will trade at a very, very deep discount or it will trade at a significant discount. Tom, deep discount is a categorical bond. There is a heading called as deep discount. So we are using it in
That's
the
only
sense
no
of
coupons
objective.
and all.
We can say it the sense of an objective, not in the sense of a product.
No deep discount means no coupon point, no coupons.
Correct. So there is still coupon here, na? That's why I can't use the word deep discount. We can use
Yeah,
the word
here is
significant.
coupon is there. Here
Correct.
coupon is
So we can say it's at significant discount, huge discount, correct?
there.
Discount to par. But that term deep discount can't be used here because
In the context. Yeah.
that's the context, that the heading is different, correct? Okay, sir. Okay, sure. We got this one. Guys, just give me 2 minutes. Kaustubh, just give me 2 minutes. By the time you read this, I'll join you in a minute. Yeah, just give me 2 minutes. Uh, guys, shall I continue?
Yes.
I hope you read this. It was effortless. Warrants are call options written by the company on its own stocks. So, guys, are we done with options in
Yes,
any
yes,
by
yes,
any?
yes.
Yeah,
Strike price and all we have seen it.
perfect. So, warrants, while issuing warrants, the company itself become a call option seller. The company itself becomes a call option seller on its own stock. Again, I'm repeating, do not overthink and do not think that these are the products trading in the secondary market, the conventional derivative market. Okay, do not overthink that. These are very yeah. So, Kaustubh, uh, uh, the options you see in the options market, I mean to say, for example, Bhavani buys a call on TCS, I sell a call on TCS. That transaction is the one I'm talking secondary market. Okay. If Bhavani buys a bond, I am offering a lower coupon and attaching warrant. This is right now a primary market. Okay. Then when Tom added that Bhavani can sell this in the secondary market, yes. Can Bhavani sell this in the secondary market? Either and both, either and both. Are we clear? Okay. When they are exercised, the company will issue more of its own shares and sells them to the option holder for a strike price. Usually the strike price is decided in advance and it is very less. I mean, very nominal number. The exercise of the warrant leads to an increase in the number of shares that are outstanding. This in turn leads to some dilution in the value of equity. Warrants are often added to the issue of a fixed interest bond to make it more attractive to the investor. A significant proportion of private placement bonds are sold with warrants. Private placement bonds, as in, we never like when I want because of when I wanted to issue debt, I never offered a public debt. I offered my debt to a private party. The private party negotiated with me. He, no, sir, your debt is very risky. We want 12, you are offering 7. In that case, while the negotiations were on, I offered warrant to sweeten the deal. It's not a public domain product. I mean, you'll never see a company going into public market and saying, come on, we are issuing bond with warrant attached. Kaustubh, the bigger disaster will be common people might not be aware only of what warrants are. So these are sophisticated products. Now you cannot offer to general public. I hope it's very clear. You know, Bhavani? Bhavani ji?
Yeah, that is for selective pricing.
Exactly. So private placement is the term we use over here, correct? Sometimes today it happens twice. I'm not angry, sir. Don't take my tone in negative tone. Huh? Sometimes Kaustubh, certain jargon, certain terms have to be used carefully. Like Tom did it twice. The first thing I remember was of deep discount. Just also you did again, sir. Concept is absolutely clear. Line was absolutely clear. Just that jargon sometimes cannot be used. Please take it in a good sense. Everybody, take in a good spirit what I'm trying to say. Certain jargons have to be used in certain place. Hello. Are we clear, sir? Tom? Yeah. Thank you, sir.
Yes.
Thank you. Thank you, Bhavani. So, warrants are also often given to investment banks as compensation for their underwriting services or used to compensate creditors in case of bankruptcy. Lovely. Kaustubh, this is where you can make tons of money, dear. Kaustubh, you imagine, na, you, Bhavani, Hansraj, Ashok, you guys set up a firm, a consulting firm, risk management consulting firm, whatever you are expert into. Now, while asking for remuneration, the other guy is quite a miser, or probably the other company does not have that kind of money to pay for his services. The Kaustubh is a clever guy. So Kaustubh says, no worries. We would like to have warrants into our company against our services offered. Provided, Kaustubh, if the business does good in the future, tons of money can be made. Are you clear? So at times, investment bankers, if they know there is a potential into the company, It's very similar. I don't remember the names, but there are certain times, there are words down the street that certain actors waived off their fee salaries and instead took some partnership into the venture. Correct? Almost same. Cost of almost same. I'm an investment banker. I'm arranging an IPO, or I'm arranging some kind of a merger acquisition deal. Instead of cash, I'm asking some percentage of the deal. Percentage could be in terms of equity. Percentage could be in terms of equity. Percentage could be in terms of warrants. Are we clear? Costo, understood now? Plenty of deals. And I believe, I personally believe this is a fantastic way of compensating the service provider. Costo, if you, me, we are not, hungry for cash. I mean, sir, there are plenty of firms. Hamara kaam ho jata hai. We make decent money from them, right? So, and this is where wealth is created. Income nahi, wealth. Long time. Tom, I think you'll appreciate. Long time. In your batch also, I must have discussed, but not in this depth. I don't remember discussing this with you in depth. Where, even I was younger, I used to hype things a lot. So when we started the business, this subject, business finance, I used to say, look, the objective is not earnings maximization, the objective is wealth maximization. Though you are the MSc, smarter, getting hold of the words. Also, when you teach younger generation, they kind of get into dilemma. Earning maximization itself is wealth maximization. So I had to tell the students, would you like to be Akshay Kumar, or would you like to be Mukesh Ambani in terms of money, ignoring the stardom and the presence? So they understood, okay, one guy is earning big time, paying huge taxes. The other guy has massive amount of wealth. So this strategy works for investment banker when there are plenty of other sources of income. Come on, guys, plenty of other sources of income. But from this one, he wants to make some wealth. Makes sense, na? Makes sense. Okay. Kaustubh, you had messaged me something, you did not, go there?
No, sir, I came back.
Oh, okay. The warrant holders are option holders. Tom, the warrant holders are option holders. They are not entitled to vote or receive dividends. But the exercise price of the warrant is automatically adjusted for any share dividends or share splits. So basically, one second, sir. 1 second. Something went wrong. Yeah. Tom, you want to ask something, sir?
And I will, after this thing, I will ask.
Just a moment. Thank you, sir. Thank you, Tom. Quite smart for this. Tom, this is a two-part sentence. Kaustubh, acha sentence hai. Pay attention. Riya, hi. Bhavani ji, the warrant holders are not entitled to vote or even receive dividend. Makes 100% sense. And why is that so? What do you own? Warrant. Is it a share? No. Is it gonna be a share? Yes. That means it's not a share. Yes. Who has a voting right? Share. Do you have a share? No. Then why should you get vote or dividend? Guys, I think I answered in the best rhetorical way possible. Correct? Your warrant is not a share. Yes, it has a potential to become share. So if the share value goes up, the warrant indeed will go up. Correct? But it's still not a share. So if it is not a share, why should you get all the benefits of being a share? Correct? So no voting, no dividend. But yes, you get the potential capital gain. No, Kaustubh, not in that tone. That is the explanation of a call option. Correct? The tone is you are still an option. You have not exercised and become a share. The day you exercise the option, become a share, at that time you claim everything what does a share have. Kaustubh, on a very, very stupid note, I don't know where this nonsense example is coming to my mind. Imagine, okay, this is stupid. Imagine, Kaustubh, I believe you are 22, 21, 21, 21. 21. What a guess. Kaustubh, so hypothetically, correct? Oh, engagement, fiance, still a fiance, not a wife.
Yeah.
So you don't get all the rights of a wife. if you got the tone. I'm sorry. Don't take it. Thank you, Ria. Thank you for taking it as a joke here. So, Kaustubh, the tone is you are a warrant, you are still an option, you are a potential equity, you are still not an equity. So, you'll not get everything what an equity gets. You're not getting voting rights, you're not getting the dividend. I think the tone is very, very clear.
Yes, sir.
Kaustubh, fiancé थोड़ी घर चलाने का पैसा लेगी. When my wife was my fiancé, she even asked, इस महीने का कितना? Sounds very weird. Okay. Okay. Is this clear? Okay. Thank you. Sorry, Bhavani. Thank you. Okay. Second part of the question. Ria, we are okay, right? Guys, Kaustubh, I'm very scared of girls here. Anytime they will say this is a bad joke. No, you should not say. And Bhavani to Bapre, Jai Bhavani. Okay.
No,
Bhavani,
sir,
let's keep it right. Yeah, Ria?
it's all right, no problem.
Oh, thank you. Okay. Thank you, dear. Bless you. But this is something very important. Let's give it a pause on my last line. The last line was you are a warrant, not a share. You'll not get the dividend. You'll not get the voting rate. What? You'll not get the dividend? Yes, you will not get the dividend. Now, this is where the catch starts. Kaustubh, imagine it this way. Okay, this is dirty. Okay, this is dirty work. Okay, hear me out. Kaustubh, you provided your services to my company. You saw potential. I told you, Kaustubh, instead of taking income from us, why don't you take some rights, warrants? That's quite an emolument for your services. In future, if we grow, you grow, right? Let's say the warrants have a gestation period of 5 years, vesting period of 5 years, and post 5 years, the warrants can be exercised. Okay. Kaustubh, I did fantastic in the next 4 or 5 years. Fantastic. The business went up like 20-30x. Okay. So you are very, very happy because it's a time for the warrants to get exercised. So you could it's finally to reap the benefits of the fruit. Na? What I did when I came to know that Kaustubh and the likes to those people whom I have issued warrants are going to exercise their warrants, what did I do? I paid the existing shareholders crazy amount of dividends. Don't you see what did I do? In a way, I siphoned off the cash. Come on, Bhavani ji, Riya ji, is this clear? Tom, is it clear? In certain situations, Kaustubh, if the company is doing such kind of dirty work, Kaustubh, you should ensure that while writing the warrants, there is a clause between you and me that, sir, if certain percentage or more of dividend is given, then the strike rate will be adjusted downwards. I mean to say for example, Kaustubh was given the power to buy the share at 100 rupees. The company declared huge sums of dividend. Now Kaustubh will say, I have the power to buy the shares at a lower rate because you have already siphoned off the cash of the business. Nice. This even happens in secondary market. If the company has declared huge amount of dividend, I think they have some threshold. I think 5% is the threshold of a dividend yield. Also, we can check NSC adjust the strikes of the options when the dividend yield is X percentage. We would like to have that X number. So even in secondary market, what does a NSC do is they adjust the strikes of the company if the dividend is sizable, so that the option buyers, specifically the put option buyers, don't get money, don't get money hands over fist. I don't know how much you understand options. Kaustubh, you understand how does a put work?
Yes, sir.
Yeah. So imagine it this way. I very cleverly bought the stock, bought the put. Correct? Company gave tons of dividend. I enjoyed the dividend. Due to the dividend, huge dividend, the stock went down. Theoretically, nonsense, I'm speaking nonsense. Theoretically, because the stock went down, put should increase the value. So technically, for the same action, I'm making money twice. Correct? That doesn't happen. The company will adjust the strike accordingly. It'll never be easy free money. Hello.
Yes.
Clear? Kaustubh, what's the dividend yield? Is it 5%?
I'm not able to find the exact material
No,
for
no
this.
problem. No
Yeah.
problem. No problem. I think a day ago or 2 3 days ago, I was checking the stock of ITC, because it's quite a favorite stock. So I also, you have to understand what I was doing, Bhavani. I was checking the stocks of ITC. 2 3 days ago, I was taking upon the strike of 250 option strike 250, put option strike 250. Yesterday, in my indicator list, all of a sudden the same option was showing the strike of 243.5. So I believe the 6.5 rupee adjustment happening in the strike on the lower side. It's because ITC must have given huge amount of dividends. I did not investigate much into this, but this is this week data. I mean, last 3 4 days data. Guys, all good? Yeah, Tom, you may please proceed. Thank you for being so patient.
Can you show me that template, sir?
Yeah, sure, please.
So that fourth one, warrants are also often given to investment banks as a compensation for underwriting services, okay, or used to compensate creditors in the case of bankruptcy. Bankruptcy means, if you exercise, there is nothing residual left, then there is no point in converting,
Yeah.
Correct.
So, partially correct, Tom. Partially correct. Tom, you have to understand the spirit of that sentence. Imagine it is such a situation where you are my creditor. I had purchased goods or services or probably something from you. Unfortunately, times are bad. I can't pay you. I tried my level best, did business, raised funds, but things haven't worked. Tom, Vodafone idea. Okay. Things have never been in my favor for the last few years, and I'm so sorry for you for that. Honestly, I don't want you to lose money. Okay. Tom is like, sir, your sweet talks don't excite me anymore. I'm going to take you to the court. I'll make you, I'll ensure that court dissolves your company and I get whatever assets I could get out of you. I started to giving you a smirky smile by saying, Tom, had I got assets with me, why would I not repay you? But still, it's your legal right. Go and sue me, no problem. Tom is finally gaining his conscience back, consciousness back, angles separated. And I told Tom, generally, I don't have assets. Honestly, taking me to the court is just wasting your time and mine. Correct? Tom is like, but sir, it's my hard earned money. I want my money back. That's a simple line. Okay. I'm like, Tom, give me one more chance. Tom is like, what chance do you want? I'm like, I'll cancel off all your amount from my books. Hear me out. Your question, as in whatever amount, let's say I'm supposed to pay you 50 crore rupees for the goods I had purchased, correct? But I couldn't pay you back. Okay. So let's cancel out that from my books. So my books become cleaner. My balance sheet becomes cleaner, lighter. Correct. I don't have the baggage of the past in the correct tone, right? Tom is like, sir, you have just cancelled my amount. You have not given me anything. I'm giving you, sir. I'm giving you warrants. If in the next 5 years, with a lighter balance sheet, with a quicker business, a lighter business model, with a new zeal, new enthusiasm, new spirit, if I could turn things around, if you let me live, you don't take me to the court, there's a decent chance if my business survives, you might get your money back in terms of wealth creation. Tom? If you pay attention, Tom, I'm sure
Yes.
you are having quite an idea about this as well, but just my duty to teach you this. If you pay attention,
Yes.
look at Vodafone Idea, what has happened over the period of time. First, guys, just because it's a classroom lecture and I'm expecting Ali is not here, but Ali might not be aware of this business. So, utility business, but unfortunately, post Geo entering the market, you can see the 104 is now close to, I think, 10 rupees or odd. It's like a 90% fall. Everybody in India knows now Vodafone Idea stock has been turmoiling since. Now, government has its AGR dues, Tom. Government has its own AGR dues. If you pay attention, government has now, since the last few years, they are not showing the previous years, the last few years, government has become a huge promoter into the company. Whereas the Birla Group, the Vodafone Group size has gone down. It is not exactly the answer to your question, sir, but this answers your question that creditors at times have their own agenda. Here I'm including government, hence I had to use the word agenda, to make the company survive, because they understand that if the company does not survive, then there could be bigger problem. In case of Vodafone Idea, Kaustubh, if Vodafone Idea does not survive, then the Bharti and the Jio will have a duopoly. I'm sure you are done with oligopoly chapter, so you are aware. Then then all this, you know, the trend in the families nowadays is there are more number of phones in home than there are number of people in the house, right? That whole system will be lost. Why? Because I'll tell you, they will just add one more digit to your monthly plan. There's like, sir, 340 ka plan, they make it 1,000 rupees. They might, Ria. Good chance. Do you have a choice? BSNL out of picture, MTNL struggling, Vodafone gone. Only two players. Those who are not aware, all except me and Tom, I think everybody here is somewhere in their 20s, early 20s. Tom, I hope we both have a memory. Just around 15 years ago, Kaustubh, there used to be Uninor, Telenor, Tata Docomo, Aircel, all gone. All gone. There used to be 8 to 10 to 12 players in the Indian telecom markets. All gone. Yeah,
That
Tom,
is
you're
because of the political agenda. That is all.
Everything accepted. Everything accepted. So here, if Vodafone does not survive, the government has its own agenda to make this business survive. Correct? Ignoring the political angle, I'm just saying sometimes the creditors are happily willing to buy the warrants to ensure that they are not stressing the company. But if the company survives, huge money can be made. Tom, I can speak one or two more examples, but honestly, these are very dark examples, but okay, this is part of life, can't change it. Some reaction? Kaustubh, itna ऐसा वाला reaction, कोई reason? any reason?
No, sir. It's all good.
All good. Bhavani ji, Tom, you're happy, sir? Comfortable? Okay, I'll take that as a yes. Okay. I think we should be done. Options issued by the company. Again, warrants can be issued to managers as a part of the remuneration. So again, this also reduces the principal agent conflict. Correct, if you remember. Guys, increasing the firm with significant amounts of convertible or warrants, that means dilutive instruments, show their EPSs on fully diluted basis. Also, earning per share, a very popular metric, is shown at basic level, at diluted level by the company. Diluted level means while calculating earnings per share, they also take the impact of warrants, convertibles issued by the company, so that the shareholder genuinely comes to know that when those warrants or convertibles actually become equity, what would be the impact on the earnings per share. Are you clear? Guys, some feedback. Are we there?
After exercising that warrants and all, number of outstanding shares will increase.
Yes.
Naturally, it will dilute the basic
Absolutely.
EPS.
Yes, sir. Absolutely. Come on. Bhavani, Riya, please. Riya.
Yeah. So how is the share EPS diluted? Like the percentage of
Denominator will increase, na?
okay.
You call it dilutive, na? Dilute ho raha na? It's more like Riya. Today you were late. If you remember, you around joined 7:30, 7:25 something. Correct, Riya?
Yes, sir.
I'm not angry, don't worry. So it was only me, Kaustubh, and Bhavani. Okay. And Riya, we are not happy you joined. You're like, sir, so angry, so bad you are. No. Why is that so, Riya? Because we guys had bought one pizza, 10-inch ka pizza. And we all four were so happy that that pizza will be split across all four of us. And all of a sudden you are also here. And we can't kick you out. Because you have a right. Riya, so per person, the pizza slice is diluted. Na? Riya, are you there?
Yes, sir.
Did you understand the example, dear?
Yes.
So what happens now? earnings per share becomes diluted because the denominator, the number of partners, the number of shares have become higher. So the per share profits have gone down. Who would like them? But that's a fact. Can't change it. Correct, ma'am?
Yes.
Lovely. Okay, I presume we are done with this. Yeah, I think winding up is that straightforward. Okay, so we're done with the long-term sources. Guys, we can take a 5-7 minute rest on this. Post that, we'll start short-term sources. Guys, okay?
Yes, sir.
Yeah, thank you. Kaustubh, Tom, shall we continue?
Yes, sir.
So, guys, going for next chapter, that's a short-term, medium-term sources of finance. Okay, short-term, medium-term sources of finance. Um, Examiner's favorite chapter actually. They do test one or two questions from here, and they are tricky. They are not as comfortable as the previous chapter. Why is that so? Because in the previous reading, if you pay attention now, majorly the reading was about debt, equity, and categories of debt, secured के अंदर fixed charge, floating charge, little bit about warrants and all, right? And those were very much handy. I mean, it's not that complicated to understand. But the current chapter, what we are discussing, they will have multiple products, scenarios, and none of the products are perfect. Of course, because there are none of the products are perfect, there are multiple products. Correct. No, nothing suits all, right? Fits all, suits all. So we have to pay attention to each of the product. Do expect one question from here. It could be a 5 marker. Do expect one question from this chapter. And yeah, so let's start. Shall we start? Yep. Okay. Come, let's start. So the category is in this short term and medium term. The previous chapter, what we did was long term. Okay. Sources of finance, as we appreciate equity, debt, debenture, retained earnings, these are long-term nature, working capital, short-term to medium-term, loans, letter of credit, VC funding, etc. The sources, these sources are used, of course, situationally. They are classified based on time period, ownership, control, and their source of generation. It is ideal to evaluate the source, short-term, long-term, medium-term, the pros, the cons, correct? On the basis of the time period, so it's categorized into long-term, medium-term, short-term. Short-term is usually has a maturity of less than a year. Okay, medium-term, more than a year runs can run up to 2 to 5 years. Longer period is beyond that. Short-term finance refers to financing needs for a small period, normally less than a year. In business, it is also known as working capital financing. Important term, remember. So when a company is facing short-term financing problem, you say it's a working capital problem. When you use the word working capital, everybody, when you use the word working capital, it's the lifeblood of business. It's a lifeblood of business. Bhavani, like the role of blood in the human body, the role of blood in the human body, the similar role is of working capital in business. Too much of blood, too little of blood. Both are bad. Both are bad. Correct? Both are causing some kind of ailment. So, too much of working capital or too little of working capital, both are bad. Okay. The role of human blood, Kaustubh, I gave, thank you for that. Tom, the analogy I gave you about blood is working capital. Is it's working? Circulating, blood circulating here and there throughout the body, right? Based on the functions. Working capital. It's a circulating capital. At times it is cash, at times it is inventory, at times it is receivable. It keeps on changing form situationally, right? But it keeps on circulating, right? That's you call it working capital. It's working. Okay. Bhavaniji's question should be, sir, what's the problem with too much of working capital or too less of a working capital? Bhavani, too less of a working capital is very, very, very much clear and understandable. A too less of a working capital would imply that the company is carrying lesser liquidity than it deserves. So maybe it keeps lesser stock, it keeps lesser cash, it does not sell the goods on credit. All these things in normal course could lead to problems. In normal course, they could lead to problems. Say, for example, if you have a monopoly sort of a business and you do not want to give credit to your customer, we understand, because anyways, customer don't have a choice. Right? But if you do not have a monopoly, there are plenty of suppliers available, and you are the person who say, no, we don't sell on credit. You can buy from other shop. The customer will go and buy from other shop. Because you don't want your money to be stuck in the business. You don't want to give them credit. Are you clear? This brings your working capital down. That means you don't have much of funds. And because of that, your top line, your revenue might weaken. So investing too little into a working capital in the normal course could create a problem. Vice versa. Too much of working capital is another problem. Why is that so? It's very similar to you keeping tons and tons of cash into your books of accounts. Correct. Savings account. And you all know, we all know that there the real rate is negative. The real rate there is negative. Bhavaniji, Tom, Kaustubh, Riya, the real rate is negative. So technically keeping too much of cash, you need some cash. You need some liquidity, contingency related area. But here, keeping too much of cash, too much of liquid assets, it's stupid. It is not earning there anything. Instead, that money could be invested, earned more, higher return, can create future wealth. Correct. So from a stockholder's perspective, listen to this one. From a stockholder's perspective, you keeping too much of cash on your books is a problem. We did not give you cash so that you keep the cash on the books. That we could have also done. We gave you cash so you allocated it finally into investments, into products which generate returns. And if you're not doing it, and there is no sound reason for not doing it, then indeed we would like to withdraw our money back, going back to dividend policy, going back to buybacks. Guys, are we clear? Lovely, lovely. Is this clear? Guys, is this clear?
Yes, sir.
Perfect, perfect. Okay. So short-term finance refers to financing needs for a small period less than a year. In business, it's also known as working capital financing. There is a whole chapter around that. Very soon we'll be discussing that chapter, probably in next 3-4 lectures, maybe 4 or 5 lectures. There are different sources of short-term finance. The very popular one, everybody must be aware, bank overdraft. Another very popular one, trade credit. If you are commerce background, bill of exchange. Factoring might be new. Commercial paper might be new. Cash credit, very similar, on the similar lines of bank overdraft. Okay. Come on. I'm presuming almost everybody should be at least knowing about the term bank overdraft.
Yes, sir.
Correct. So it's more like you have 5 lakh rupees into your account and you visit the bank, avail a bank overdraft facility of probably 20 more lakh rupees. So technically you have 5 lakh, but the banker is now allowing you to withdraw to the tune of 25 lakhs top side. 5 lakh of your own, 20 lakh OD facility. Correct. Interest will be charged only on the excess amount withdrawn. Number 1. There will be some minor fee charged for the bank OD facility. Number 2. And the darkest line is anytime the banker can say your bank OD limit is withdrawn, please reinstate the balance. This makes bank OD facility a not so reliable one. Everybody, to my knowledge, you guys are done with economics. Again, to my knowledge, in economics, you know monetary policy. So if you connect that, remember or collect or connect it. Kaustubh, what should I connect? Kaustubh, recollect karo. If central bank, to implement the monetary policy of the government, wishes to reduce the money supply into the country, one of the things they could do is they could ask the bankers, the bankers, the cooperative societies to reduce the bank OD facility or to cut the bank OD facility. So when a banker is cutting back on his bank OD facility which he has offered to you, technically either something you have done bad, your credibility is spoiled, or papa ka pressure hai. Papa ka pressure as in central bank ka pressure. Come on, all good.
Yes, sir.
Kaustubh, you're always there. Bless you, bacha. Riya, all good, dear? Bhavani ji, Tom sir,
Yes.
Anushka ji. Anushka ji, your alarm was of 8 a.m. Huh? Lecture was at 7 a.m. Okay, okay. Yeah, please, Tom, sir, please. Sir, please continue. Tom? Tom, there is a hand raise. I'm expecting you to speak.
This is overdraft. If the RBI's policy, because of RBI policy, the bankers ask the creditor to pay immediately. So the contract can be redrafted.
Are you trying to say it can be renewed?
Yeah, it can be renewed. No.
See, answer is yes, but the spirit is lost. See, with the same bank, renewal and cancelling the original OD is not making sense. Same bank. If you're a businessman, you must be having good relations with multiple banks. Now, there is a good chance that the NBFCs or the cooperatives might still give you the OD facility. In that situation, what you could do is avail a
Papa is
new OD.
RBI. Papa is RBI, so it RBI has the same regulation for all the NBFCs and all.
Accepted. Absolutely, and very, very nice. The question is, at times, certain institutions have a lag in policy implementations.
Right.
Correct. So you can make benefit, because if my banker says, sir, within this week clear of the entire bank OD limit, how do I get so much money from here? Correct, na? So at times you might need some other ongoing facilities to repay the other ongoing facilities. Tom, I hope you got the spirit.
But RBI may penalize the bank,
Can't deny. But again, lags are there, and there are certain banks, who have the habit of, they please the client. They please the client. They please the client. For them, the client is the back end regulation they can manage. For them, getting the client is more important. Are we clear, sir? Let's not name banks.
Yes.
Okay. Let's continue. An OD is a form of short-term borrowing from a bank. 1 second. Okay. OD is a short-term borrowing from a bank, where the borrower is granted a facility to draw money out of the current account such that it becomes negative. Maximum it can go down to an agreed limit. Borrower pays interest only on the amount which he has actually withdrawn. No explicit capital repayment. That means you can just deposit the interest and the principal into the same account. Separately, like a debt, you don't have to honor the separate coupons. All interest entries, all principal entries are done through the same account. OD made to companies are usually secured by a floating charge. In the previous reading, we had learned fixed charge versus floating charge. So floating charge means the collateral will keep on changing its nature. Guys, are we clear? Yeah. Okay. 1 second, dear. Okay. The ODs made to the companies are usually secured by a floating charge. The interest charge on the OD will usually be higher than a loan of an equivalent amount. That's make OD a slight on the expensive side. And I think everybody understands it's a facility. Facility is charged. Guys, come on. It's a facility. Na? For enabling a facility, you have to pay. Guys, come on. Give me some feedback.